Hi, my name is Cusimano, and this is my investment strategies video or analysis for Finance 452. The strategy I chose was made famous by Mr. Peter Lynch. The strategy is the PEG, or deals with the PEG ratio. He basically created the PEG ratio, which is calculated by taking the price to earnings ratio divided by the historic growth of a company. Basically an easy calculation. You can find these on Yahoo Finance and in the statistics. You can get the PEG ratio. What it basically reads is the lower a PEG ratio, the more it's undervalued, the stock itself. And with efficient markets, if it's undervalued, people will catch on and they'll start to buy it, hopefully raising the stock price. If it has a high PEG ratio, it means it's overvalued, which basically means that people are going to catch on to that in efficient markets and they're going to sell it off, lowering the stock prices. In theory, now this doesn't always happen, but this is in theory what we expect to happen, or what Mr. Lynch thought was going to happen. So for my analysis, I basically took our Haywood Gibbs scholarship portfolio, the one we've been working on for our final. I decided to take that portfolio and go through it, pick the 5 highest pegs and the 4 lowest pegs, and pin them against each other and see what the return or the risk were for the past 5 years historically. I also, just out of curiosity, wanted to see how they fared against a market. So I used the S&P 500 as my market proxy to go ahead and see how the ratios versus the market as well as each other. So for the 5 high peg stocks, I used Pfizer, which had a peg of 5.75, Johnson & Johnson at 3.16, AT&T at 3.0, IBM at 2.43, and 3M at 2.34. Like I said, these were the 5 highest stocks in this portfolio. And here are the lowest, or the low peg stocks, the 5 lowest that we had in the portfolio. Energy actually had a negative 4.54, ExxonMobil at 1.36, Tyson Foods at 0.62, Comcast at 1.05, and Qualcomm at 1.36. So after doing a basic analysis of risk and return, I calculated the percent change of the return, or the weekly returns of each of these stocks for the last 5 years. I equally weighted them at 20% apiece, and I came up with the portfolio return and risk measured by standard deviation. And as you can see on this slide, the return for the high pegs were 0.23% at 1.73% risk. The low pegs had a slightly higher return with a higher risk, and the market was slightly higher than the high pegs but lower than the low, and the risk was in the middle. So basically, to my analysis, I didn't find any evidence that there was an advantage to the high peg or the low peg. Basically, it all would come down to risk and how much risk you wanted to take for that specific return. You basically are indifferent. Now, I don't think Mr. Lynch got to be one of the well-known investors by simply being indifferent on different stocks or different portfolios. So I do believe that there's more into the PEG ratio than just saying, okay, is it high or is it low, and how we should pick stocks. I think he definitely got more into the fundamentals and the financials of each individual company. So this analysis doesn't prove